In this video, we're going to talk about forward prices. So, what is a forward price? A forward contract, we have to start with a forward contract. A forward contract is a contract to buy or sell an asset at some point in the future. The forward price is the price that makes this contract fair. So first, so that we understand what that means, a fair contract is one that does not cost any money to enter into or close out of. Present value of a fair contract is zero. Now, we can think about, let's do an example just to make sure we understand why a forward price might exist. So a forward price exists. Let's say a stock is trading at $100, and I'm going to trade a forward contract with you tomorrow, that expires tomorrow. Intuitively, if I agree to buy that stock from you tomorrow for $1,000 and it's trading today, that seems like a pretty good deal. A pretty good deal would mean that the present value of that contract is in your favor. I'm losing money if I enter into that contract at zero present value. Alternatively, if I agree that I will buy that stock from you for $1 tomorrow, that's pretty bad for you, right? It's worth $100 today. I'm buying it from you tomorrow for $1. That's not a great contract, and so that contract probably has a negative present value for you. There must be some price in between $1 and $1,000 for which it's fair, for which you're indifferent to whether you go long, you agree to buy, or you go short, you agree to sell. So there are different prices, and the different strike prices for these forward contracts, so the strike is the price at which we agree to buy or sell, the different strike prices for the forward contracts yield different present values. So fair is going to have zero present value. Now, when we talk about trading a forward, then we mean a forward contract. When we talk about the forward for an asset, that's the forward price. They're both called forwards, and depending on context, we're either talking about the price or the contract. So we have to be careful with context here. Okay, forwards and futures contracts. So in this presentation, we're going to consider futures contracts as a specific style of a forward contract. The primary difference between the two is how collateral and margin is handled, and also, the other difference that shows up regularly with futures contracts is the delivery rules can be fairly complex, and of course that changes the value of the contract. So we probably could spend a semester on understanding, say, how collateral and margin works, on how and why delivery rules for these contracts are set up. We're not going to worry about that. For us, we're going to have a forward contract. You're buying or selling an asset at some specific point in the future. Okay, first we need to talk about arbitrage. So arbitrage is the ability to make profits without making an investment or without taking any risk. Typically, one loses money on risk-free transactions due to transaction costs, meaning that you trade these transactions with a slightly negative present value. If you were to buy a share and immediately sell it, you're going to lose the bid-ask spread, right? You will lose the difference between the bid and the ask. You buy at too high a price, you sell at too low a price. Fair is somewhere in between. Now, arbitrage would be you could sell at too high a price and buy at too low a price. And of course, we can't do that in the market typically. Now, we assume that arbitrage opportunities do not exist. One cannot make profit without taking risk. Now, that doesn't mean that one cannot make a loss without taking risk. And the market's always on the lookout for people who are willing to take losses without taking risk. And we also there is a specialist person in the market. We call that a market maker, and the market maker does have the ability to make profit without, in theory, taking risk. So market makers can make profit, and this is typically in the form of a bid-ask spread. So market makers can make a little bit of profit through the bid-ask spread without taking risk, although again, market makers do take risks, so it's not for free. We, as market participants, don't have the ability to do that, and we assume we can't. Now, this is a really powerful concept. we can use it to do all sorts of things. And this is the key to derivatives pricing. So let's suppose, and let's find an arbitrage opportunity here. So we have a non-dividend paying stock. So a stock does not pay dividends, has a price of $40. We can trade, buy or sell a forward contract with a price of 65. The continuously compounded risk-free interest rate is 5%, and there's no cost to borrow the stock. So is there an arbitrage opportunity? And that 65 seems really high compared to the forward. And if I can trade a forward contract with a strike of 65 for no cost on a stock that's at 40, I'm going to trade. I would like to, well, let's see. That forward price, the 65, seems really high. If some price is really high, I want to sell at that price. So I'm going to agree to sell the stock in 3 months at $65. So now I've entered into a forward contract. Now we're assuming a couple of things. Forward contract's uncollateralized, so there's no collateral. And second, we can go long or short the stock, and we can go long or short the forward at no cost. So basically we can buy, now we have to pay for it, but we can buy or sell the stock whenever we feel like. So what do? How do we capture this arbitrage? So let's think about the transactions that we can make in order to capture the arbitrage. Okay, so today, what do? We're going to sell the stock forward in 3 months for $65. That's what we decided. The price was too high. Someone is willing to buy it for $65. That sounds great. In order to sell the stock in 3 months, we need the stock. So we're going to borrow $40 for 3 months. We're going to buy the stock for $40, and we're going to wait. In 3 months, we have to do a bunch of things, right? We own the stock, so we're going to deliver the stock into the forward contract. They agreed, our counterparty agreed to pay us $65, so they give us $65. We have to repay our borrowing. So the borrowing is $40. Interest rates were 5% for three months, quarter of a year, so that's $40.50. We just made $24.50 risk-free. Now let's think for a second. What if we made a mistake? What if we chose the wrong direction? Today, we decided to buy the stock forward in 3 months for $65. We borrow the stock for 3 months, we sell it, receive $40, and we invest the $40 at the risk-free rate. In 3 months, we receive $40.50, that's that investment of $40. We borrow $24.50 because we have to pay $65. We buy the stock for $65. We deliver the stock, right? We just now have the stock. Remember, we borrowed the stock for 3 months, so we have to give that back. So we deliver the stock into the short, and we just lost $24.50. If you make a mistake like this, you have to reverse all of the trades. You have to unwind, do the opposite, right? Instead of buying the stock forward, you should sell the stock forward. Now, one comment I should make, let me go back to the previous slide for a second. In these transactions, nothing happens between today and 3 months' time. The stock still exists. The stock doesn't pay a dividend. Nothing happens with the forward contract. Whatever could happen. We're making an assumption that nothing happened between today and 3 months. And that's actually a pretty important assumption. And as we go forward thinking about forward prices, we're going to have to explore that assumption a little bit. If some things can happen, like a dividend, that's probably going to affect the arbitrage, and we need to think about that. Okay. So that was our arbitrage opportunity, and it's fairly straightforward. If you choose badly, you go through a series of arguments, prove that you screwed up, and you try the opposite. Okay. Now we assume arbitrage does not exist when pricing derivative securities. We use arbitrage, like we just did, to find the prices of derivative securities, but we assume it does not exist, and we assume a correctly priced derivative does not allow for arbitrage. And we're always on the lookout for arguments, transactions, trades that can take place, which allow us to lock in an arbitrage. And if we think we find one, we've got to think pretty hard about, is the market wrong, or are we misunderstanding something? Are we actually taking risk? So The previous example showed that if there is an arbitrage, we ought to be able to find a risk-free strategy that captures it. Now, some assumptions about forward prices. We just said the market does not allow for arbitrage. There are no transaction costs when trading the asset. Remember, we just bought and sold the asset at some price. There's no credit risk in the market. Everybody performs in all transactions. No margin or collateral will be assessed against the transaction. There are no intermediate cash flows, like a dividend, arising from the position in the asset before the forward date. All transactions do not have market impact. We can short the underlying asset. Now, we can relax some of these conditions. We can take account of transaction costs. We can deal with credit risk through collateral. We can deal with intermediate cash flows as long as we know what they are. We can't really deal with arbitrage. We can't use these arguments when we buy and sell the stock, it actually moves the stock price. And we'll see later that not being able to short the asset actually causes us some problems. Okay, so the forward price. We're going to use S to denote the spot price of the asset. Think of a stock. F is going to be the futures or the forward price today. T is the time until delivery. R is the risk-free interest rate. We'll make it continuously compounded. And let's take an asset which has no yield, no income, does not cost anything to borrow it. If the spot price of the asset is S and R is the T-year risk-free interest rate, then the forward price for contract deliverable in T years is F equals SE to the power RT. S, the spot price, E to the RT is that spot price grown to the time T at the risk-free rate. So, let's go through the arguments. Today, I'm going to take you through a couple of arguments which prove, again, under those assumptions, prove that the forward price is SE to the RT. So we have two parts to this argument. The first part, today we're going to agree to sell the stock forward at time T for some price F. And we're going to assume there's no cost to this transaction. We're going to borrow S, whatever the stock price is, at the risk-free rate until the maturity. We're going to buy the stock for S, and we're going to wait. At maturity of the contract, we are going to deliver the stock that we own into the forward contract and receive F. We have to repay our borrowing, S e to the RT. For no arbitrage to occur, we can't make free money. We received F, we repaid S e to the RT, so for no arbitrage to be true, we need F is less than or equal to S e to the RT. Okay, we can do another argument. That was our first argument. Second argument. Today, we agree to buy the stock at time T for F. We're going to borrow the stock today. We're going to sell it and receive S, whatever the stock price is, and we're going to invest that money at the risk-free rate. Now we wait. We get to time T. Again, nothing's allowed to happen between now and time T. We redeem our investment for SE to the RT. We pay F and receive the stock, and we return the stock back to the lender, whomever lent us the stock in the first place. Again, we're not allowed to have arbitrage, which means we can't make risk-free profits, which means that SE to the RT has to be less than or equal to F. The previous argument said that F is less than or equal to SE to the RT. This one says F is bigger than or equal to SE to the RT, which means that F has to be equal to SE to the RT. So we've just used arbitrage to find the fair forward price. So let's do a couple of examples. In our first example, we want to look at a non-dividend paying stock trading at 110. Risk-free interest rates are 4%, and we want to know what the 6-month forward price is, and then we want to work through the no arbitrage arguments for this price. So our formula is equal to S e to the RT, or in our case, 110, so the spot price is 110, e to the 0.04 times 1/2. So let me flip to the calculator. We have 110 times 0.04 times 0.5 e to the x equals, so 112.22. 112.22. So that's our forward price. And we have two arguments to go through: the long, buying the forward, buying the stock in the future, and the short, selling the stock in the future. So let's go long. So today, we agree to buy stock for F in 6 months. If we're buying the stock in 6 months, we're going to need to be short as our hedge. So we're going to borrow the stock from someone, sell the stock for 110, and we're going to invest 110 at 4% for 6 months. Now we wait till 6 months is up. In 6 months, we're buying the stock for F, so we pay F. We receive the stock. We return the stock to the lender. And what do? We've got an investment, so we redeem our investment for 110 e to the 0.04 times 0.5, which is 112.22. Now we've paid F, we received 112. For there to be no arbitrage, 112.22 has to be less than or equal to F. Right? That's our fair argument. So let's look at the other argument. So in the other argument, we're going to agree to sell the stock for F in 6 months. We are going to, if we're going to sell it, then we need to own it. So we're going to borrow 110 at 4% for 6 months. That's the money we need. And we're going to buy the stock. Okay, so we've sold the stock forward, we borrowed money, and we bought the stock. We wait 6 months. And what happens? Well, we've sold the stock, so we sell the stock. We receive F. And then we have to repay. How much do we repay? 112.22. No arbitrage says that the money we receive has to be less than or equal to the money we repay. So F is less than or equal to 112.22. Well, we've just proven that F, 112.22 is less than or equal to F, and F is less than or equal to 112.22, so the fair price is 112.22. So those are our arbitrage arguments. Let's do another example. In this example, we have a non-dividend paying stock trading at 57. Risk-free interest rates are 2.5. We want to know what the 2-year forward price is, and we want to know the no arbitrage arguments that give us this price. Our forward price, F, equals SE to the RT, which is 57 e to the 0.025 times 2. Let's pull up our calculator. Okay, 57 times 0.025 times 2, take e to the x, equals 59.92. So 59.92. And again, we go through the same arguments we did before. Today, we go long the forward at a price of F. If we're long the forward, meaning we're buying the stock in the future, we want to short the stock today. So we borrow the stock, we sell the stock for 57, and we invest 57 at 2.5%. In the future, in 2 years, and again, we're assuming nothing happens between now and 2 years from now, we're long the forward, so we're going to pay F, we're going to receive the stock, we're going to return the stock to the lender, and we're going to redeem our investment for $59.92. No arbitrage says that the amount we pay, F, is bigger than or equal to $59.92. We can do the same thing if we go short. So today we're going short. Today we go short the forward. We sell. We agree to sell the stock in 2 years at a price of F. If we're short, we need to own the stock. So we borrow 57 at 2.5%, and we buy the stock. And now we wait 2 years. Again, we're assuming nothing can happen between now and 2 years from now. We're short the forward, so we sell the stock, we deliver the stock into the forward, and we receive F. And we have to repay our borrowing. So we repay $59.92. No arbitrage says that F is less than or equal to $59.92. The amount we repay is bigger than the amount we receive, which means these two things combined, it says that F, the fair forward price, is $59.92. And if you notice, if you think about these arguments a little bit, what you'll see in this argument on the left, we invested $57 at 2.5%, and on the right, we borrowed $57 at 2.5%. Really, the difference between, in this particular example, the difference between buying something now and buying something in the future is the cost of risk-free borrowing.